Okay, let's dive into this. Welcome to The Explainer. Today, we're unpacking what honestly might just be the absolute biggest shift in the housing market we've seen in a really, really long time. Look, if you or maybe someone you know has ever felt like the whole dream of homeownership was just locked behind this invisible gatekeeping system, well, you're absolutely going to want to pay close attention to this one. Because what we're looking at right now is a fundamental redesign. It's basically a brand new architecture for American mortgage credit. The heavy hitters, the major players who actually write the rulebook for lending, have just updated their scoring models. And guys, this is a massive structural change. It's the kind of thing that could finally, literally unlock homeownership for millions of just regular, everyday responsible people.
To really grasp why this change is so monumental, we've got to start with this wildly frustrating paradox. Why doesn't your rent count? I mean, think about the everyday reality for millions of folks. You sign a lease, right? You write that check where you set up the auto pay on the first of every single month religiously, year in and year out. You are literally proving in real time your ability to handle a massive monthly housing payment. And yet, you walk into a bank, ask for a home loan, and that flawless track record, poof. It essentially vanishes into thin air. It is incredibly common to have this absolutely stellar history of renting, only to get denied a loan by the exact same bank that trusts you with a checking account. It's kind of like proving you can run a marathon every single month, but then being told, sorry, you don't qualify for a gym membership. Make it make sense, right?
And honestly, it gets even more ironic when you look at the raw economics of it all. In a lot of markets right now, renters are actually paying way more per month than they'd be paying for a mortgage on the exact same property. You are literally proving you can afford a mortgage by paying someone else's mortgage plus their profit margin on top of it. But traditionally, the credit system gives you absolutely zero reward for that flawless history. None. It's just this massive, glaring, systemic blind spot. For decades, the system has effectively ignored the single largest, most consistent payment most of us make in our entire lifetimes, simply because, well, it wasn't officially structured as debt.
So the root of this whole problem really comes down to an industry term you've probably heard, a thin credit file. Now let's be super clear here. Having a thin file does not mean you have a history of bad financial decisions. It doesn't mean you're defaulting on loans or declaring bankruptcy. Not at all. It simply means you are highly financially responsible, but you're getting completely overlooked by lenders because you just lack traditional credit cards or large auto loans or personal loans. You operate on cash, debit, direct payments. You pay your rent, your phone bill, you buy your groceries, but to the traditional algorithm, you're basically a ghost. It acts as this invisible barrier, keeping perfectly responsible adults totally locked out of the housing market just because they don't borrow enough money in the quote-unquote right ways.
But here is where the massive paradigm shift finally comes in, and this brilliantly illustrates the change that is actually happening right now. The old rules, super rigid, heavily reliant on those traditional credit cards and large loans. But the new rules, they change the game entirely. The government-backed mortgage giants, we're talking Fannie Mae and Freddie Mac, the institutions that basically write the rulebook and set the standard for the entire mortgage industry, they have recently approved updated credit scoring models. These new models are finally going to consider on-time rent payments, they're going to look at your utility payment history, they are actively looking at alternative financial behaviors over time. They are finally actually measuring how you handle your real-world obligations rather than just grading you on how well you juggle credit card debt.
So you're probably wondering, how big of an impact is this actually going to have? Well, we are talking about 7.7 million people. Think about that for a second. This is not just some minor tweak to an algorithm that helps a tiny handful of people on the margins. No. According to the estimates, just by factoring in rent and utility histories, these updated scoring models could help 7.7 million Americans finally reach a qualifying credit score for a traditional mortgage. That is a truly staggering figure. I mean, we're talking about millions of people who have been totally invisible to the system, suddenly crossing the threshold and being recognized as the qualified, responsible borrowers they have literally always been.
Now, what's really interesting about this slide is exactly who makes up that 7.7 million, because it is a massive cross-section of historically overlooked groups. Think about young adults, right? Folks just entering the workforce who haven't had decades to build up a massive credit card history. Or think about the modern economy. Freelancers, self-employed workers, gig workers. These are people who might have irregular income streams but incredibly consistent, rock-solid bill-paying habits. Consider immigrants, who often arrive with a completely blank slate in the American credit system, regardless of how financially stable they actually are. And of course, just people who genuinely prefer to live their lives without traditional credit cards. If you, or maybe a friend or family member, falls into any of these categories, this systemic shift is directly targeting the exact hurdle you've been banging your head against.
Let's move to and see how this builds across the broader economy.
Because obviously, a change this large does not happen in a vacuum, right? It creates massive ripples. Starting right at the top, we're going to see a wave of more qualified buyers entering the market. And alongside that, we'll see drastically increased mortgage access for non-traditional workers. It's finally aligning lending with the actual reality of today's gig and freelance economy. And when it comes to sheer volume, experts project this could unlock hundreds of billions of dollars in potential new mortgages. Hundreds of billions! But honestly, perhaps the most important part for the stability of the entire system is that this leads to much better risk assessment. See, the banks aren't lowering their standards here. They are actually just getting better, more accurate data to identify who is truly a responsible borrower, rather than just guessing based on a really limited, outdated profile.
Okay, but as much as we absolutely love to celebrate a more logical, fair system, we definitely need a quick reality check here. Earning a qualifying credit score, that is just the key to the front door. It doesn't automatically buy you the house. The fundamental core laws of real estate still apply 100%. Inventory still matters. There literally have to be homes actually available to buy. Affordability still matters, especially since home prices in a lot of areas are still hanging around near record highs. And, of course, interest rates still matter deeply because they completely dictate what your actual monthly payment is going to look like. Buying a home isn't going to magically become easy overnight just because the credit score math changed. Those real-world market forces, yeah, they are still very firmly in play.
So the crucial point is really this. Financial responsibility comes in many forms. For way too long, the financial sector demanded that every single person fit perfectly into this one specific, narrow little box, just to prove they were trustworthy. What this shift by Fannie Mae and Freddie Mac really represents is an awakening. The lending system is finally evolving to recognize that consistent, responsible behavior, whether that's paying your electric bill every month, covering your rent, or managing alternative finances, that is valid, undeniable proof of your character and your capability. The architecture of the whole system is expanding to actually meet people where they live and how they actually spend their money.
So this really leaves us with one very direct question to wrap things up. If you've been renting responsibly, if you've been paying your bills on time, month after month after month, but you always thought homeownership was just completely out of reach because of a thin credit file, well, is it time to explore your options? The rules of the game have fundamentally changed in your favor. The exact same credit score that held you back yesterday might not be the score you generate tomorrow under these new models. It's a genuinely fascinating evolution in the market, and one that is empowering millions of people to finally take that next big step.